Joining us now is Mark Matson, the CEO and founder of Matson Money. Thank you for being with us this afternoon, Mark. We appreciate your time. Love your background.
Thank you.
Of course. Now, I guess let's start with just some takeaways from the market action in recent days. And I guess we'll start with Friday into now.
Yeah. So I love what our previous guest said. He said it was surprising. We didn't see it coming. That, my friends, is the nature of the market. All of the knowable and predictable information about the future is factored into prices today. Therefore, only random or unknowable events will change market prices moving forward. And that's why many analysts just say, oh, well, we were surprised. Well, of course, because markets are random and unpredictable by nature. And that's why investors need to be looking not for the next 10 minutes or even 10 years. They need to have a long-term portfolio that doesn't have to depend on a short-term prediction about the future, because if your portfolio is dependent on a short-term prediction, it's already broken. Equities are long-term holds, and asset categories, most investors are making a big mistake right now because they have so much of their money in just large U.S. tech stocks, ignoring the rest of the globe and ignoring other small and value stocks in the U.S. market. They're not learning lessons from the past, which is if you put all your money in large U.S. growth stocks and tech stocks, you can lose 50% of your money overnight.
Very quickly, and we've certainly seen it this earnings season, too, as an example. So if an investor wants to approach this volatility and uncertainty in the market, what is the best approach right now? Yeah,
the best, it's easy to say, hard to do. The best approach is diversification. It's almost all the Magnificent Seven. You got NVIDIA, you got Apple, you've got Amazon, you've got maybe some Tesla, so it's all, large tech stocks. And I want to, look, the history doesn't always repeat itself, but it sure does rhyme. From 95 to 2000, large U.S. stocks made 22% per year for 5 years running. Tech stocks made 45%, 5 years running on average. And then what happened? Everybody dumped all their money into it. And I see that happening today. So you better own microcaps and small stocks. You better own international stocks. You better own some emerging market stocks. And to the extent you can't take a full risk on equities, which could, Marley, if we look at it, stocks could lose 40 to 50% when they're volatile on the downside. You better have some short-term, high-quality fixed income to rebalance your portfolio and buy those stocks while they're low instead of panicking and selling when you're trying to market time.
So those are some of the do's for the current market. Now, what would you say some of the don'ts are? What do investors need to look out for? What kind of behaviors are we trying to avoid?
I call this toxic investing. Tony Robbins wrote in a recent book called The Holy Grail of Investing, talk about hyperbole. The idea that many people are falling into is if you want to be a billionaire, invest like a billionaire. But the reality is so many people have tried to be a billionaire and lost everything and went totally bankrupt. So some things you want to avoid, run the other way. We mentioned it earlier, over $100,000 for one Bitcoin that is actually based on no value at all. You're not buying a business. You don't get a bond buying a business. You don't have any guarantee. You don't have anybody guaranteeing the bond. If you were buying a bond, you don't own any stock in a company. It's all based on the bigger fool theory. The idea that P.T. Barnum said there's a sucker born every minute. The idea that someone's going to pay you more for something that's inherently valueless is definitely a toxic situation. Hedge funds in general are toxic. They charge you 2% of your fees, then 20% of any of your gains. You should stay away from those with all of all of your prudence. Don't get sucked into that. You don't want to get sucked into dumping your money just in the Magnificent Seven, in 7 tech stocks. I can't think of anything more dangerous. And you have to stay diversified and sit on your hands. A lot of people are going to be surprised if this market turns really super sour and then they're going to be panicked and not know what to do.
What would you say right now is the biggest driver of making a mistake from an investment perspective? Is it big headlines? Is it negative news? Is it earnings? Is it poor guidance?
Well, that's a great question. I've spent the last 34 years trying to train investors to understand this. But the number one thing is chasing past performance. Most investors only look at the last 3 to 5 years. They see what was hot. They see what made a lot of money. They dump all their money into them after the fact. So they're chasing the returns. They're also chasing the headlines. On the other hand, when things turn bad and you get markets crashing like 2008 and 2009, they're still looking at the headlines, but this time they have the fear not of missing out, but the fear of losing all their money. So you see people in 2008, 2009, instead of buying more stocks while they're low, they're panicking and getting out of the market, not getting back in until it goes up 100 or 200%. And it's an age-old story. You know you should rebalance, you know you should diversify, you know you should buy when prices are light, but you got instincts. You got the headlines. Your instincts are always going to be your enemy. Your emotions are fear and greed. Your instincts are to run towards things that are pleasurable, that are making money, and run away from things that have just lost money. So your instincts, your emotions, and the headlines.
So you're a buy the dip. Don't buy it on the positive. Buy the dip, and that's the approach.
You want to rebalance your portfolio. First of all, you want to start with the portfolio. Most investors have no idea how much risk they really have. So the first thing you want to do is analyze your portfolio and see on down markets how much of your portfolio could you really lose. And then you want to build a portfolio maximizing the return for the amount of volatility you're willing to take. And then you have to stay disciplined over 30 years. And that is, it's the same reason people don't stick to a diet. The cheesecake tastes good. Discipline's a tough thing to do. And for investors, it's almost impossible.
Discipline and thinking long term. We appreciate it. Thank you for being with us.